So let's now start with how Basel 1 calculated the risk charges. So please recall, in Basel 1 the credit risk charge was calculated as simply 8% of the risk-weighted assets. And how the risk-weighted assets were calculated is cash was assumed to have a 0 risk weight. So if you are holding cash or claim on OECD central governments, so OECD is Organization for Economic Cooperation and Development, these are the developed countries normally, or if you're holding claims on any central government in its own currency, so if you're having Indian government bonds in the Indian rupee, then that would all be considered risk-free and there would be a 0% risk weight. On cash to be received, that is account receivable claims on OECD banks and non-OECD banks below 1 year, the risk weight was 20%. Residential mortgages carried a risk weight of 50%, and all other loans, regardless of their risk profile, carried a weight of 100%. This is where the regulatory arbitrage came in, or this was the problem, that all other loans were given a blanket 100% risk weight. So if you've given a $100 loan, 100% of $100, that is $100 into 8%, would be the credit risk charge according to Basel 1. So we would do a similar calculation for all loans in the portfolio and compute the total credit risk charge or the capital that the bank needs according to Basel 1. A bank subject to the Basel 1 Accord makes a loan of $100 million to a firm with a risk weighting of 50%. What is the basic on-balance sheet credit risk charge? It would be 50% into 100 into 0.08. That will be $4 million. A lot of time banks have off-balance sheet items or off-balance sheet credit risk. So if the bank has given a guarantee, and the guarantee is that if the counterparty defaults, the bank will make good the payment. So if there is a default by somebody else, the payment may come due on the bank. Such guarantees, etc., are referred to as off-balance sheet charges, as this guarantee would not come in the assets or the liability side of the bank. However, it still is a risk. So for such off-balance sheet items, the credit exposure is calculated as the notional amount of the guarantee, for example, multiplied by a credit conversion factor. So for instruments that are substitute for loans, the credit conversion factor would be 100%. For translation related contingencies, the factor is 50%. For short-term self-liquidating trade liabilities, for example, accounts receivable based liabilities, there will be a 20% credit conversion factor. So if it's a $100 type of exposure that we have guaranteed, or it's an off-balance sheet item, then 20% of it is what we will have to keep a capital charge or capital against. Commitments with a maturity greater than 1 year will have a 50% weight. So this is a guarantee that can be invoked only after 1 year, then the weight will be 50%. So on and so forth. Generally, if something like this comes, you will be given the risk weight, but please note, for off-balance sheet items, the exposure is the notional multiplied by the credit conversion factor. And then the credit risk charge is calculated as 8% multiplied by the risk weight multiplied by the credit exposure multiplied by 50%. So this multiplication by 50% is generally done because the credit quality of these borrowers or of these players in the derivatives markets and in these off-balance sheet markets is generally quite high. So it's other big banks that we'll be dealing with. So off-balance sheet risk can also come because of derivatives. So there may be a derivative contract that we have entered into. At the moment, it's just an agreement. So if I long forward, it would neither be an asset nor be a liability. It's just a long forward contract. However, in the future there may be an exposure or there may be some buffer that I may need to keep right away, even though at the moment I may not be in the money or out of the money. So the credit exposure for derivatives specifically is calculated as the net replacement value plus an add-on. The net replacement value is simply how much in the money or out of the money we are right now. So if we are in the money, then there will be some exposure. If we are out of the money, then there is no exposure for us. We are the credit exposure. So NRV is the net replacement value, that is how much in the money are we, plus an add-on. And this add-on is to basically account for the volatility and the risk that we may come in the money in the future. So the add-on is calculated as the notional into the add-on factor into 0.4 plus 0.6 into net to gross ratio. Net to gross ratio basically depends on how much netting etc. we have done. So if nothing is mentioned, then just assume the net to gross ratio to be equal to 1. If there is some netting and there is some risk benefit from that angle, then the net to gross ratio will be given to you, and this number will be less than 1 if there is some netting benefit, and you can input that number in the add-on calculation. So the add-on factor accounts for the volatility of the various items and derivatives. So if it's an interest rate based derivative, then for maturity less than 1 year there is no add-on factor is 0. For 1 to 5 years it's 0.5. For greater than 5 years it's 1.5. Exchange rate and gold is more risky, hence volatility is higher. So for less than 1 year the add-on factor is 1. 1 to 5 years it will be 5, and greater than 5 years it will be 7.5. Similarly for equity, precious metals and other commodities, we have the add-on factors given. The add-on factor will help calculate the credit exposure, that is the net replacement value, how much in the money we are, plus this add-on factor, that is the notional into the add-on factor into 0.4 plus 0.6 into NGR. Please note the add-on factor is a percentage. So 7.5% or 6% will be an add-on on the notional or to our credit exposure. So the credit risk charge will be calculated as 8% of the risk weighting into the credit exposure multiplied by a further 50% generally, because these are off balance sheet items and the credit quality in the derivatives markets and these markets is generally high. Consider a $100 million interest rate swap with the domestic corporation. Assume a residual maturity of 4 years and a current market value of $1 million. What is the credit risk charge? So let's first compute the exposure. That will be the net replacement value plus an add-on. The net replacement value is given to be 1 million. That is the market value of the swap. Plus the add-on will be the notional multiplied by the add-on factor. So it's an interest rate swap. So for interest rate items of 4 years, that is between 1 to 5 years, the add-on factor is 0.5. Generally this will be given the add-on factor into 0.4 plus the net to gross ratio is not given, so we will assume it to be 1. So the exposure will come out to be 1 million plus 100 million into 0.5% into 1, that will be $1.5 million. The credit risk charge would be calculated as 8% into the risk weight, which is not given, so we'll assume it to be 100%, multiplied by 50% multiplied by the exposure, that is 1.5 million, which will come out to be $60,000. The Basel I Accord computes the credit exposure of derivatives using both replacement cost and an add-on to cover potential future exposure as we studied. Which of the following is correct credit risk charge for a purchased 7-year OTC equity index option of 50 million notional with a current mark to market of 15 million with no netting and a counterparty weighting of 100%. So it's an equity index 7-year. So let's first see the add-on factor. Equities for greater than 5 years would be 10%. So we'll calculate the exposure first as 15 million plus the notional of 50 into the add-on factor of 10%, that is 0.1, into 0.4 plus 0.6, that is 1. So it will be 15 plus 5, that is $20 million. And the credit risk charge can be calculated as 8% into the notional into the counterparty weighting, which is now given to be 100%. So the risk weight into 50% is given to be 100%. So you'll simply multiply this with 100%. That will come out to be 1.6 million. If the risk weight was given, we may need to have multiplied by 50%, but the counterparty weight of 100% is given, so do not again multiply it with 50%. We'll next go on to study the capital requirements under Basel II. So please note, a major reason that Basel II was brought in was to combat the regulatory arbitrage, that is, the same $100 loan, whether it earns us 20%, that is whether it is given to real estate, or if it earns us 8%, even though it may be given to a very high quality FMCG company, the capital requirement is still the same. It is still 8% of $100 because the risk weight is 100% regardless of the quality of the corporate loan. Hence, if you invested your $100 in a bad quality company or in a real estate company, then your return on equity would look to be much higher, assuming there was no default. Whereas in FMCG, if you gave good quality loans, then your ROE was lower. Hence, in good times when defaults are not expected, banks are incentivized to give only riskier loans according to Basel I, because riskier loans get them good return, give them good valuations. Whereas if you give safe, secure loans, then you're seen to be not earning any return. Basel II tried to combat this by bringing in a variable risk charge depending on the quality of the underlying credit. A bank that funds itself at LIBOR minus 5 bips purchases an A-rated corporate floating coupon loan paying LIBOR plus 15 bips. Based on the Basel I minimum capital requirements, what is the annualized return on regulatory capital for this loan? Let's assume the loan was $100. So on $100, we are earning LIBOR plus 15 basis points and we are paying LIBOR minus 5 basis points. What we have to keep as regulatory capital is 800 basis points of 100. So it will be 100 into 800 basis points. So the return on regulatory capital can be calculated as LIBOR will get cancelled, 50 minus 5, 10 upon 800, that is 1 upon 80, my apologies, 20, 15 plus 5, 20 upon 80, that is 1 upon 40, which is nothing but 2.5%. So good quality loans were giving us less return on capital, bad quality loans were giving us higher return on capital because the capital requirement was the same regardless of the quality of the corporate loan. So we'll first study how Basel II valued and identified a risk charge for credit risk, So Basel II allowed banks to follow one of three approaches to compute the credit risk charge. The first approach that was advocated for smaller and unsophisticated banks was the standardized approach, wherein your risk weight would now not be a blanket 100% as in Basel I. So depending on the credit rating of the corporate, this risk weight would change. So for AAA rated or AA minus sovereign corporates, the risk rate was 0%. For banks, it was 20%. For short-term loans, it would be 20%. And for corporates, it would be 20%, assuming they were AAA rated. For BB rated, similarly. For unrated corporates also. So now the risk weights vary depending on the credit quality. Lower the credit quality, higher was the risk weight. Higher the credit quality, lower the risk weight. The calculation was similar to the Basel I calculation, that is 8% of the risk weighted asset into the notional. However, these risk weights would be taken from these standardized tables that were given by Basel II. So unsophisticated banks and smaller banks who did not have or who do not have the wherewithal to have big risk management teams and risk calculation teams can follow the standardized approach to calculate the credit risk charge. The second approach allowed was the foundation internal ratings based approach, wherein banks were allowed to calculate their own probability of default. So from its own internal calculations and risk management systems for each loan that the bank had given, the bank, subject to supervisory guidelines and supervisory reviews, could calculate its own probability of default. Of course, to be able to use the IRB approach, the bank has to demonstrate sufficient sophistication of its risk management systems and sufficient guidelines and supervisory reviews in place. Only then the regulator would allow the bank to use the IRB approach, and if allowed, the bank would be able to calculate its own probability of default. Once the probability of default is calculated, the risk weights are prescribed by the regulators. That is, if you consider the probability of default to be 1%, then a risk weight of 92.32% would be applicable. If the probability of default is 0.03%, then the risk rate would be 14.44%. That is, exposure at default or credit exposure the bank still couldn't calculate on its own. It was only the probability of default that the IRB approach allowed banks to calculate on their own, and then depending on the type of loan and the probability of default, the risk weights would be prescribed by the regulators. The calculation would again be 8% into the risk weight into the notional. So the exposure was still not calculated or is still not being calculated by the banks on their own in the internal ratings based approach. In the third approach that is allowed for credit risk, that is the advanced internal ratings based approach, the banks can calculate the loss given default and the exposure at default also on their own. So the capital charge would then be the exposure at default multiplied by the risk weight multiplied by 8%. So this need not be the notional as was the case with the IRB approach and the standardized approach. So even the exposure at default the bank could calculate on their own. Now what this does is that this exposure will be lower if you have collateral or third party guarantees or credit default swaps, netting, etc. All this was not recognized in the IRB and the standardized approach. The standardized approach says, okay, if you don't have sophisticated risk management systems, just keep 8% of the risk weight of the notional in your equity or as a capital buffer. With the advanced ratings based approach, now this will only be allowed to be used by banks that have very, very good risk management systems, and you have to demonstrate to the regulator that yes, your risk management systems are sufficiently advanced and sufficient stress testing, back testing, and other supervisory reviews are done in place so as to ensure that these calculations are correct. So then you can further reduce the capital charge by taking the benefit of collateralization. Or if you've given $100 loan, or that's the notional, but $80 is a collateral, then your net exposure is only $20 at default. However, the collateral would be given a haircut. So the value of this collateral can fluctuate with market risk or with market values, and hence the volatility effect is measured by a haircut parameter that is approximately a 90-day war over a 10-day horizon. And for equities, the haircut parameter generally comes out to be, this number comes out to be about 25%. So the exposure after risk mitigation would be whatever is our original exposure, that is 100, and we'll take that exposure up by a haircut factor, because in the coming days this exposure can further go up, minus the value of the collateral, for example $80 in this case, and the value of this collateral we will take down by 25% or by a haircut, because in bad times this collateral could go down while our exposure went up. So this is just to be conservative, we will take the higher of the exposure. So the uncollateralized exposure, we will raise it by a haircut factor, and the value of the collateral will bring it down by a haircut factor. So the first haircut factor on the collateral is for the volatility of the collateral, and the second haircut factor is the volatility of foreign exchange if it is a collateral in a different currency. So both these collateral factors are a function of the volatility or the war of the underlying assets. Finally, if we've invested in securitized assets, we need to first ensure that significant credit risk has been transferred, that is, it is a true sale. So if there is an SPV, there is an originating bank, the originating bank transfers the assets to the SPV. The SPV then makes various securitized assets out of these loans, and we take an exposure into any of these securitized assets. Then again the risk weight would depend on the rating. So if you are invested in the highest tranches or the senior most tranches, they would generally have a AAA rating, and the risk weight applicable would be 20%. If you've invested in the equity tranche or the last tranche or the subordinated tranche, then the rating could be B plus or even below, for which we have to keep a 100 or 1250% credit charge. So if you are investing in the equity portion of this securitized, then for $100 loan we would effectively have to keep $100 buffer, because 8% into 1250% into $100 would again become $100, or 8 into 1250 would become 100%. So if you're investing in the equity tranche of the securitized transaction, then whatever you are investing will all have to be separately kept as an equity buffer. That is, you can't invest borrowers' funds in that. Entire $100 will go from your equity. A true securitization is where significant credit risk has now been transferred onto the new investors. Seller does not maintain any effective or indirect control. Securities are not an obligation of the seller or the originating bank, and the holders of the SPV have the right to pledge or exchange those interests. That is, I can sell my stake to somebody else, or I can pledge this stake and borrow against it if I want. So if these conditions are met, these are the risk weightings that would be applied if we invested in securitized assets. Which of the following statements about Basel II capital requirements is false? It increases the risk sensitivity of minimum capital requirements for internationally active banks, that's correct. Risk sensitivity goes up, that is, the capital charge is now more dependent on the risk of the borrower. It only addresses credit risk and market risk, that is false, because it also addresses operational risk. United States insurance companies are not required, that's correct. Basel II is for the banking sector. Banks are not allowed to use their internal models for credit risk in determining the capital requirements. That's also incorrect, because the internal ratings based approach and the advanced measurement approaches are allowed. The latest proposal of the Basel Committee, that is Basel II, it's no longer latest, introduces the advanced internal rating approach for credit risk. Banks will input their own loss given default as well as the exposure distribution or the exposure at default. So both the exposure as well as the loss given default will be entered by the banks if they are allowed and they demonstrate sufficient sophistication so as to be able to use the advanced internal ratings based approach. This is B.